was a tough 2015 for most equity investors, including the most legendary one of all, as Warren Buffett's company Berkshire Hathaway experienced perhaps its worst year since 2008. Shares of Berkshire's A and B shares were each down about 13% in 2015, with the A shares ending the year at just under $195,000 US apiece, while the B shares, or so-called baby Berkshires, traded for about $130 US each. But despite a down market in equities last year, it just might surprise you to find out which sector has been the beneficiary of Buffett's latest spending spree in 2016. The last time the Oracle of Omaha's company did so poorly was in 2008, when both classes of Berkshire stock fell 32%. Of course, 2008 was a lousy year for just about everyone. Remember that whole financial crisis, Great Recession thing? But as bad as 2008 was for Berkshire, Buffett still wound up outperforming the broader market that year as the S&P 500 plunged over 38%. In 2015, Buffett lagged the market, and badly. The S&P 500 was down, but only by about 2%. The last time that Berkshire had a down year and underperformed the S&P 500 was all the way back in 1999, and that year saw the S&P 500 gain 19.5%, while Berkshire's A shares fell 20% and the B shares were down 22%. However, even though the overall market was down last year, there are some similarities to 1999 to help explain why Berkshire had been a worse investment than the S&P 500. In 1999, large tech stocks soared, and in 2015, they were a big reason why the index hadn't suffered a worse drop. Netflix and Amazon had each more than doubled, and Google was up by more than 40%, while Facebook had gained more than 30%. And just as Buffett lacked exposure to the Microsofts, Cisco's, Qualcomm's, and Sun Micros of the world in 1999, he had no investment in last year's Fab Four of tech. So not only did that hurt Berkshire, but, making matters even worse, is the fact that many of Berkshire's largest holdings tanked as well. So what did Buffett go out and do? He placed a bet of nearly $1 billion on the oil sector since the start of the year. That's how much Phillips 66 stock Berkshire Hathaway has bought so far in 2016, according to company filings, the most recent of which was made last Wednesday. Berkshire already owned over 61 million shares of the oil refining giant and has recently spent almost another $1 billion to buy an additional 12 million shares of the company. With that purchase, Buffett's firm now owns 14% of Phillips 66 shares, making it Berkshire's sixth largest holding. Now, Warren Buffett is famously a value investor, often buying stocks in a down market. So why would he be interested in an industry that has seen the price of its major commodity devastated over the last 20 months or so? It's because an oil refining company, Phillips 66, can benefit from falling oil prices, which means that Phillips can buy the crude it refines more cheaply. And it profits handsomely from the fact that the price of gasoline hasn't fallen nearly as much as the price of oil has. It wouldn't be a stretch to suggest that his many fans and investors probably aren't too upset with his foray into the oil patch. After all, Buffett is no day trader. He invests with an extremely long-term horizon that has served Berkshire extremely well over the decades. And if history is any guide, Buffett and Berkshire Hathaway will bounce back once again this year.